Second part of this chapter is the trading mechanics. So how we trade. Futures market has exchanges called clearinghouse. Clearinghouse. So clearinghouse is a facilitates trading. They basically are the intermediary between two traders, long and short position. And what they do is they close out the positions. So we don't need to meet the counterpart. We basically just pay or receive money from to the clearinghouse exchanges. And exchange is basically matching the trade, like a reversing trade, and take or make deliveries. That's what the clearinghouse should do. And most trades reverse, which means most trade like a long shot, they are offsetting each other and then do not involve actual delivery. They usually do not deliver actual goods. So the purpose of the futures is not just getting the commodities or getting assets at a agreed upon price or sell asset at a agreed upon price. Then maybe the purpose of having futures contract may be speculation, which means you want to make money from the price of the asset, price change of this asset, then you can get the futures contract, or you can also use the futures contract as a hedging, as a risk management tools. Again, we'll see how to speculate, how to hedge later on. So the term open interest is defined as the open contracts not offsetting each with the reversing trading. That's called open interest. So this is the diagram with the trading with or without clearinghouse. So the A is the forward contract. No clearinghouse. B is the futures contract. There's a clearinghouse. So just go to money from long to short. The goods asset goes from short to long. But now you have intermediaries. So the benefit of having intermediaries are you basically get service from them, and also you can avoid counterparty risk. You don't have to worry about default risk a lot. I mean, I'm not saying that there's no default risk. It's possible, but you don't have to concern that much because of this. So to join the futures contract, like futures market, you have to set the margin account. So you have your own account, and the clearinghouse, the exchanges basically settle, so change the account balance every day, daily basis, based on the asset of futures. Okay. So it's very similar to the margin trading, if you remember. Now there's a maintenance margin that you need to maintain at a certain level. If your account go below this level, then you get margin call. You need to put additional cash or have to lower your number of positions to set your account, margin account as initial margin. The price of futures and spot should be the same at maturity, at delivery date, right? Because on that day, it's not really futures anymore, right? So that's called the convergence property. The price of futures converge to the spot price at maturity date. So let's see example of the maintenance margin. Suppose the maintenance margin is 5%, while the initial margin was 10%. The value of the coron, so coron is the asset, 1,870. So when do we have margin calls? Then the margin call will go out when the original margin account has fallen about in half, because initial margin 10%, maintenance margin 5%. So half of initial margin, right? Which means if you lose the half value, then margin call should ring. It's going to be 1,870 times 50%, which is $935. Okay, right? And each 1 cent decline in the corn price, how much you lose? You basically lose $50 loss. Okay, because you have 10% initial margin and 5% maintenance margins. So the futures need to fall only by 19 cents to trigger a margin call. Okay, so you are going to get margin call pretty easily, not very different, like because you have a lot of margins, actually, lots of margins. I mean, let's look at more detail about it in the next example. Okay, this is the futures example, marking to market. So assume the current future price for silver, so this is silver future. Okay, and this is the price. So delivery 5 days from today. So this 5-day futures, $16.10 per ounce. So futures price equals to 16.10. Suppose that over the next 5 days, the futures price evolves as follows. So this is the futures price for 5 days. Now let's see daily values. So suppose you have 5,000 ounce contract. Means that per ounce, I mean, you have 5,000 ounce contract. First day, the price increased by 10 cents, right? So the price increased by 10 cents here, right? And you have 10 cents and contract size is 5,000 ounce. So you have $5 increases, right? Now next day, another 5 cents. So 5 cents times 500, $250 increases. And then next day, we have 7 cents decline. So $350 loss. Fourth day, same, so 0, right? And fifth day, 3 cents increases. So $150 increases in your account. So in total, you have $550 increases. Okay. So basically, for 5 days, you have these changes. It's actually same as initial day to the 5th day changes, which is, I believe, how much you have? The 11 cents increases, right? Times 5,000 contract ounce, it's going to be 550, right? So it's same as your price at expiration date, which is the same as this future price, because of convergence property, this will be the price at maturity minus future price will be your profit if you have long position. If a short position, then future minus price will be your profit. So short position holder lose money, long position make money. And your account change based on these daily changes. The major difference between forward contract and the futures contract, because there's margin call, even though eventually you make money, you probably need to add more cash sometimes when you get the margin calls, during your holding period. That's major differences, okay? So that's why when you buy futures contract, even though, say, if you have like 6 months futures, you expect that the price eventually will rise, but sometimes in the short term, like someday you need to put more cashes. If you cannot make these cash, like the put the cash, then you are default. So to avoid that, you need to have some kinds of the extra cash to be prepared. So that's major difference between forward and futures contract. Forward contract doesn't matter whether the price is fluctuate or not. You obviously just need the delivery date price, but futures contract, you should be prepared because sometimes it's possible for you to add more cashes into your account to avoid default from margin call. Okay. So mostly the settlement is actually cash settlement, not really actual delivery. Actual delivery is not very common. So you basically just pay cash values. The previous example, you just receive cash, right? You just receive cash, $550. That's it. You don't need to really have 5,000 ounces of silver. Because once you get delivered, then you have to sell it. You don't have to do, because from marking to market, you get your cash. These commodity futures basically traded, regulated by the Commodity Future Trading Committee, CFTC, and exchange may set a limit on one-day price changes to keep to avoid the fluctuations, basically. How to pay tax? You have to pay tax based on the year-end price, year-end cumulative profit and losses. Doesn't matter whether this position is closed. So you just compare the year-end price, year-end cumulative profit and loss, and pay tax. So that's how to trade futures.